Hello, everybody. Kirk Spano, Investing 2020s, and today we're going to cover the monthly Global Trends ETF report for August 2023. I put it out a week early for two reasons. The first reason is we have the Fed meeting, and I incorporated a little bit of talk about that into this article. And I have a 401k launching this weekend, so I wanted to get this out so I could send it to the company. And I guess there's a third reason. It's because the Wisconsin State Fair opens up the first week of August, and I will be there eating corn. So I wanted a couple days off early in August to go see the racing pigs and eat some corn. Now, as a reminder, this is an article that is at both Margin of Safety Investing and Global Trends membership at Fundamental Trends. And all the memberships above get this. Here it is over at Margin of Safety. So let's take a look. First thing we're going to talk about is entering 20-year U.S. Treasury ETF, which we've talked about a couple times already. Shooters coverage of the major markets, trading QQQ, whether the Magnificent Seven can hold it up. I wrote an article, which is an excerpt of this one on Seeking Alpha today. You can see what we think of QQQ at the moment. We talk about ETF asset allocation, funds to be using, looking at adding, and then the 401k model portfolio. So I am placing 401k plans again with small and mid-sized companies, and I have found one that allows me to manage a portfolio within their platform using the menu of ETFs that we get to choose from. And it's very cool that we get to use ETFs versus having to use mutual funds. So let's take a look. Major markets, we're comparing Spider month-to-month with itself and TLT, the 20-year U.S. Treasury. Why those two things? Well, SPY is generally considered the market by people, right? It's the 500 biggest stocks. Even though there's over 5,000 stocks out there, these 500 account for about 90% of the market capitalization. That's pretty huge. Remember, the top 7 companies right now are something along the lines of half of the market capitalization of the whole market. 7 stocks, might be 40%, but it's a big number. So we have some gigantic mega cap companies that carry the indexes, in particular S&P 500, but also the Russell 1000, which is the S&P 500 plus another 500 companies. QQQ is 100 stocks on the NASDAQ, not entirely overlapping with the S&P 500, but they're all in the S&P 500. So what is a market cap weighted index? This is important to understand. The biggest companies influence the index the most. And right now, the Magnificent Seven, as it were, are accounting for about 70% of all the gains on the stock market so far this year. Now, that's both in QQQ, which we'll get to in a second, and the S&P 500. I wanted to look at different scenarios with S&P 500. And one of them, it's pretty standard, is that we're getting a small pullback, kind of a pause that refreshes, that will lead to a new rally, and potentially new highs. There are other potential situations out there that we have to be aware of. And we take a look at QQQ to find those, but there are different choppy patterns that could happen. We could go into a range-bound market for a while or for years. The S&P 500 would look like this too. But the S&P 500 right now, what we're really trying to figure out, is this going to be a small correction or a big one? I think it might be right in the middle. We'll see. I'm going to give you a rationale, and I think it might be right. What if the Fed has done a good job? I know, heaven forbid. But what if the Fed has done a good job? What if printing the extra money wasn't a mistake? What if the inflation had more to do with China, Russia, and Saudi Arabia than with the monetary policy? What if they raised it about the right amount with the right amount of QT, quantitative tightening? And what if they back off at just the right moment? Then maybe we just need a little bit of consolidation and a small pullback before the rally resumes. What Shooter has said, that very well could be what is happening. He sees great potential that SPY is in a wave 3, which means a small pullback, then wave 5 would jump up. We'll see. But we could be heading to 600 on SPY maybe next year. That'd be a heck of a rally. Tom Lee is in that camp. He says the next year or two. We'll see. It's something to be open-minded about. For the last couple of months, I've been talking to you about being positive, not always seeing all the negative. Now, I get accused of being a perma bear because I have called the last four major corrections. Last five, I guess if we include 2018, five. I called the 2018, 20, and 22 bear markets, the financial crisis, and the dot-com crash. I still have clients. They're all getting pretty old. But I still have clients that remember me telling them get out of the stock market in 1999 and 2007. And it's all published here that I told people to get out before 2018, 2020, and 2022. So we'll see how this goes. The in-between correction, that one that's like almost a bear market, like 18, 19% down, or just barely a bear market, 22, 23% down. That one seems to me the most likely scenario because I think there's enough international risk and banking risk out there to cause some panic at some point and to really wring out price discovery, some valuation modeling or free cash flow modeling that actually gets priced into the market. A couple of years ago, I wrote an article about stock market being overvalued, but doesn't matter. I still think we're kind of in that era, especially with a lot of young investors, a lot of emotional older investors. Sometimes valuation doesn't matter. The world is good when things are going up. The world is bad when things are going down. The world is bad whenever there's an election around the corner. So 2/3 of the time, we think the world's bad, even though the stock market goes up more than 2/3 of the time. There's that disconnect 1/3 of the time when things are good, but we think they're bad, right? That's why sometimes good news is good news and sometimes good news is bad news, but sometimes bad news is bad news. And sometimes bad news is actually good news, right? Makes me go way back. Who said there's knowns and unknowns? We have the known knowns, the known unknowns. But it's those unknown unknowns that really get you. Well, it's not Dick Cheney. Somebody he worked with, though. Don Rumsfeld. That's who that was. I had a friend who knew him very well. I made a friend who knew Dick Cheney very well. Interesting stories. In any case, we'll see what happens. The trade that we've talked about a couple times is the iShares 20-year Treasury bond, that interest rates pretty much have to head to around 3% on the short term and the long term. I also see kind of a weird thing happening with the bond market. Normally, it's inverted or not inverted, but very rarely is it level. I think in the slow growth forever world, with huge deficits in most countries, I believe that the yield curve might be weirdly level for an extended period of time, where the 2-year Treasury and the 10-year Treasury aren't much different. Why would that be? Well, somebody pointed out an article on Bloomberg. Actually, somebody tweeted it, or as of today X'd it to me. I don't really know. I don't like X.com as the name because I think that there's way too much that could be read into that. However, he pointed out this sure seems like slow growth forever that you've been talking about for over a decade now. And it's like, yeah, it sure does. Slow growth forever is the idea that aging demographics, technology, and the eventuality of cheap energy are all deflationary. And right now, healthcare in the future is really the big inflationary force. In the short term, obviously, during the energy transition, price of energy has gone up for a little while, but it's come back down. Definitely a manipulated market. But the reality is that 2/3 of the people on the planet have reached the middle class. We only have 1/3 of the people left who have to get there. And I'm being generous with that, with China and India. Billions of people have already moved generationally into a better standard of living than their parents or grandparents were in the emerging markets. So the growth that came out of China for 30 years is not likely to happen again. India's starting from a little bit better place than China did, and the rest of the emerging markets are too. So a combination of fewer people starting a little bit better than their parents and grandparents means that most of the growth will still come from the emerging markets. Something like 2/3 to 3/4 is what it looks like over the next generation, but not as much as the last generation on aggregate. Certainly in certain places, though, which is why we pick our spots. But slow growth forever in a world with aging demographics and the deflationary pressure of technology means that we print money to offset the deflation and the debt, which is also deflationary. So there are far more deflationary factors in the economy than there are inflationary. And the inflationary are essentially counter-cyclical, but really they've been, since the Great Recession and the financial crisis, counter-secular. The secular trend is deflationary, and we're fighting it with inflationary monetary policy that's now lasted 15 years. And we'll see if artificial intelligence can save us from an inflationary shock related to healthcare. In most of the world, they probably don't have to worry about that as much as the United States, because in the United States, we've allowed our healthcare system to become twice as big a part of our economy as it is in other developed nations. But we just invested in a company that looks like it's going to help bring healthcare deflation in the next several years, ahead of the last baby boomer getting on the Medicare. So if the major force is deflation and not inflation, which is what most people think, is that it's inflation, and they're wrong. They've been wrong a very, very long time. One little pop in inflation has to do with coming out of COVID, energy transition, and manipulation by foreign powers that they could only hold up there for a year. The reality is that inflation is not a problem. And all these people like Peter Schiff who thump their chests on it and build a career on it, and then people leave them to come to me, which has happened 3 times because he really doesn't know what the hell he's talking about, right? Everything's been a bubble to him for over 20 years. He got the housing market right. Absolutely, he did. That's about it. He hasn't got anything else right. So in a deflationary world, you have to have interest rates come down. And we're around 4% on the 20-year treasury now, and that'll come down to around 3%. There's very little risk in owning TLT right now. You might not make a lot of money, but you'll probably beat the bank, and you might get a 10 to 20% capital gain, maybe even 30 to 50% if there's a panic, and probably there will be someday. Maybe for a hot minute we see 20-year treasuries go back down to 1.8%, which is where they were for just a moment after COVID. So it's low risk, some upside, and in a panic, a lot of upside. That's why you get into TLT if you ever own bonds, ever. Some people never own bonds, and that's okay. Buffett says don't bother. But I want to give people the opportunity to have some money in their bonds. And because I run a 401k plan and have retired investors, it's the prudent thing to do, because we know that the 80-20 portfolio, 80% equities, 20% bonds, if the bonds are correctly selected, will make you about the same as a 100% equity portfolio. 60-40 is dumb. It's always been dumb, even though everybody talks about it. And it's especially dumb now that interest rates aren't coming off of, teen interest rates that we had in the 80s. 60-40 made sense for a little while when interest rates were super high, double digits. Unless we get interest rates in double digits or approaching double digits, 60-40 will never make sense again. But TLT is low risk and has some upside. So let's talk about QQQ, because this is the fund that beats the S&P 500 over virtually every rolling time frame. This is our core ETF, the 100 stocks on the NASDAQ 100. It's not perfect. And if there was a heavily traded alternative that threw about a dozen other S&P 500 stocks in here, I would want it. And those do exist, but they're not very heavily traded. They're not very liquid, which means that you have a hard time getting in and out. We don't want hard times getting in and out. If I want out, I want to be able to do it in 3 seconds. So the Magnificent Seven, which is what I called these companies over a year ago, and Jim Cramer said it less than a month later. And I know they know who I am because I've written for them. Microsoft, Apple, NVIDIA, Amazon, Alphabet, Meta, and Tesla has accounted for 70% of the return of the S&P 500 this year. 7 stocks, because they're big. They're really big. Now, these aren't the stocks that did the best necessarily, but because they're huge, it's market cap times return. Even if there's stocks out there with $15 billion or $20 billion market caps that made 100% or 200% this year, they don't have the impact that these do, being up 30, 40, 50%, because they're multiplying by 300 billion, 500 billion, 700 billion. Case of Apple, 2 trillion more. So market cap weighting is what drives a lot of this. So when you take a look at the S&P 500 or QQQ, you really only have to take a look at the 10 biggest stocks. Then you'll know about what the market is doing, even though the market is many more companies. That's why it's important to have a good asset allocation with your ETFs. And then if you have a 6 or 7 figure portfolio, you should cherry pick the best stocks, or at least the ones with the most upside. Because as Peter Lynch said, we only need a few huge winners to move the portfolio up significantly. So This is the 7 stocks powering QQQ. They're all up. Nvidia went up the most because of AI. Microsoft's done pretty well. Meta's done pretty well. Right? Tesla's turning over right now. So let's take a look at Tesla. I talk about it here. In my opinion, Tesla is overvalued by hundreds of billions of dollars. It doesn't make any sense to me that Ford and GM are under 100 billion. This is a company flirting with $1 trillion. They don't sell as many cars. They don't have the real estate assets that Ford and GM have. Remember that story. So a lot of people are new listening. GM and Ford own factories that won't be making cars in the next few years. They can either sell them and take the cash or use their technology like they did when they built ventilators during COVID and get into other businesses. I believe they're both going to become military contractors in a not too distant future. I mean, they both are, but I mean more. I think Tesla is worth between $300 and $500 billion right now, and that bakes in an awful lot of upside. That's still a pretty optimistic view, in my opinion. I think for them to be $1 trillion company, I mean, you're looking 10 to 20 years out. It'll happen, but to go from 500 billion to $1 trillion, who cares? That's not that big of a move. It's a double. Give me the company like Ford at 50 or 60 billion on the idea that it's going to get to between 300 and 500 billion. Make 5 or 10 times their money instead of maybe 2 times their money. Talked about that earlier too. What is more? Is more to go from 100 billion to 150 billion, $50 billion gain, or is more to go from 300 million to 5 billion, a $4.7 billion gain? Well, Kirk, obviously it's the 50 billion. No, it's not. 300 million to 5 billion is 17 times your money. 100 billion to 150 billion is 1.5 times your money. Would you like 17 times your money or 1.5 times your money? Not a hard question when you think of it that way, is it? Small companies and mid-sized companies have a lot of upside. When you use funds, they're harder to find because you get a basket. When you buy stocks, you can just buy your 10 or 20 best ideas and hope that you're just a little bit better than the average bear. Was that a boo-boo? Just a little bit better than the average bear? That's all you gotta be. So with regard to QQQ, though, what if Tesla's correction that seems to just be starting ends up being a 30 to 50% correction? And they're a huge part of the QQQ return. And what if all the other companies in the Magnificent Seven are overvalued somewhere between 10 and 50%? Let's just say on average 20%. If most of these companies drop 20%, Tesla drops more than 20%, people start panicking and selling QQQ, which means all the other stocks in that index go down, you get a 20% correction. I think the correction coming is around 20%. Might be 23, might be 17. Hard to know. And I think that what Chairman Powell says this week matters. He's going to raise interest rates a 1/4 point. And I think we're still going to get mean Jerome Powell. I think he's going to warn people against thinking this is the last time, even though I do think it's the last time. He wants some price discovery. And the quantitative tightening, the Fed sucking money out of the monetary system, might be all that we need to get that correction. Maybe we don't have to see interest rates go up. We just have to have uncertainty about them coming down. So I think QQQ is vulnerable. Shooter's charts say that it's vulnerable, right? He shows us in here. Could get really low. Probably not. He's got it in the 350s. But that's the bullish scenario. You have these other scenarios where it just becomes really choppy for either a short time or a long time. There's a lot of things in play right now. I would say that this market in general is the least certain that I've seen in quite a while. It's not like the end of 2020 and 21. It's not like the end of 2019 or the end of 2021 when you could forecast a correction. I maintain that the 2020 correction would have been similar, just stretched out, even without COVID. But right now, you take a look at this market, and I don't think you can forecast with certainty where we'll be in 6 months. We might be at a record. We might be down 20%. We might be down 40% if Jeremy Grantham is right, and we have to wring everything out of these bubbles. I think there's been enough of that stretched out over a period of time, and we know that time heals all things, that I don't think we get the Armageddon zombie apocalypse. I think that's less in play now than it was a year ago. And we talked about it being in play a year ago. I think the next several months could be tough. I think we'll get volatility. I think we'll get opportunities in that volatility. That's always what we want. Shooter says that he thinks he'll be stuck for a while, and that my COVID thesis appears at this point in hindsight to be spot on. Remember, I said this back in 2020, that they were overspending and we should ask for a reason why. And I think it's tied to the slow growth forever and the boomers all hitting Medicare at the end of the decade. Because without healthcare deflation, which I think we're going to get, we didn't know that a couple of years ago, right? The AI is a big deal. And we talked about Watson 2.5 years ago. Take a look at the special on IBM Watson on 60 Minutes. Go to their website and look up IBM Watson Healthcare. We're going to have such good diagnosis and treatment plans, probably 30 to 50% lower prices than we have today. And theoretically, it should be about 2/3 cheaper, but you know that the hospitals and everybody will stick their greedy little fingers in there. And why do I say 2/3 cheaper? Because the AI is that much better than the doctors for diagnosis and treatment plans. I've told the story about the doctor who was treating my grandmother. She was 92 at the time, I think. And I asked her about her specialty, and she was a traveling nurse. She was the head of the department as a traveling nurse. She was an AI specialist. Came in for 6 months to get all their AI systems running. So 3 years ago, IBM Watson was diagnosing things at about 90% correct. Doctors are a little under 30. And correct means the right answer right now. The doctors usually get there. Sometimes you die, though, in the meantime. So the AIs are really good at this. They're going to cut a lot of costs out of the system. And there's no fighting it for the doctors. There's no fighting it. They fight a lot of things. They can't fight this. The doctors who don't use AI will no longer be doctors. That is what you should know. Because from the top down, AI is getting pushed into every corner of medicine. One of our friends, the ones that we go to New Orleans with, she's a speech pathologist. And they threw together an AI conference in Washington, D.C. 4 or 5 months ago. I said, everybody come out here for this. AI is going everywhere in healthcare. That is very, very deflationary. So that was, I guess, an aside. But it does play into the possibility there's going to be a lot of shaking out in the markets because people don't understand it. People still talk about inflation more than they should. So as far as QQQ is concerned, my form of analysis looks at the money flows. If the stock market gets back down to the October lows, we better not break through because there's very little interest here in stocks. It's where people will just be scared, and then you could see super low prices. I don't think that happens. I think the QQQ bottoms out in the low 300s. If it even gets that low, might stay up here at bull market support, which we talked about at the top of the program. So we'll see. I'm going to scale in up here if there's not horrible downward momentum. You have to respect the technicals in real time. And then again down here in the low 300s, because I think that'll probably be a pivot point. Something bad would have to be going on for me to worry about this stuff down here. And remember, Jay Powell can always come to the rescue, which I'm sure he would. He's already talked about not wanting to see this happen. Just talked about it last week. And he said, I basically end quantitative tightening and lower interest rates if I have to. So he's telling you the blueprint. Follow the blueprint. Your building will stand. All right, some other ETFs we talked about. Grayscale Bitcoin Trust. I still own that in a handful of accounts that allow it, and I own it. It is down to about a 25% discount to net asset value. Remember the discount was what, 55% shooter? It was that high, right? So it trades like a closed-end fund, and they want to become an ETF. I mentioned 6 months ago that BlackRock was talking about having an ETF for Bitcoin. Do you know how many times, and now that they've filed, right? Now BlackRock has filed. Do you know how many times BlackRock has been turned down for an ETF in their history? It's an easy number to remember. It's 0. They've never been turned down for an ETF. If BlackRock wants a Bitcoin ETF, what's going to happen is they're going to get it, and the rules that they work out will be the rules that the industry follows. Grayscale will switch to those rules, and they will become an ETF. The discount will disappear, and that's when you should sell it and just buy Bitcoin. So the reason to own a Bitcoin ETF in the future, I guess, will be so that you can trade it in an IRA. But outside of an IRA, you should just own regular, plain old Bitcoin, whether you do it at your brokerage or at a crypto shop, whatever, and then throw it in the cold storage. If you're going to own Bitcoin, you need to learn how to do it and understand the reason to learn is that Bitcoin is the international currency hedge. and it is developing fast. You just had 60 emerging market countries show up in Costa Rica or El Salvador or something to talk about this. How do we navigate between a world of China and the United States? It's Bitcoin, man. It's Bitcoin. They're all buying it. It just doubled in the last 7 months from the time I said it would double. Now, it's going to pull back a little bit here short term. Shooter says 27, 28,000. Some other guy I respect says 24, 25,000. Buy the dips on Bitcoin. It should be a single-digit percentage of your asset allocation, the same way that people always told you to own a few percent in gold. If you want to trade it if you want to trade it with Shooter at fundamental trends and the rare investing, certainly can do that. 4 out of 5 people shouldn't try to trade, and I know that 4 or 5 won't. Did you catch that? It was a joke. If you're going to trade, do it right. Go with Shooter. Otherwise, don't trade much. Do the super slow trading that I do, right? Like 2 trades a year. And I got stopped out of the ARK Next Generation Internet ETF, ARKW. I had a 5% trailing stop on it, so I no longer own it. It has Block in it, Tesla, Unity, Shopify, and it also owns the Grayscale Bitcoin Trust. So the reason I own ARK Next Generation Internet is because I love e-commerce and everything tied to it, but I wanted Bitcoin exposure without it being direct Bitcoin exposure. So I got quite a bit of Bitcoin correlation. And now that I think there's a small correction coming, I got stopped out and I'm going to look to buy it again. I bought it down around 40, sold it up around 64. Make no doubt about it. Kathy Wood is a crummy trader, right? Crummy trader. But her big picture ideas are mostly right. So during bull markets and FOMO rallies, you can use her funds as a proxy. ARKW if you're pro Bitcoin, and then just regular ARK if you're not. I'm starting to add to the Energy Select Sector Spider, XLE, because most of the tax credits are going to the big guys. And that's what this fund is. Invesco Wilderhill Clean Energy, I cut back on, but I will get back because the big secular trend is clean energy. And it's probably the biggest secular trend in history. We're going to cut our fossil fuel usage 70% by about 2040 or so. It's only 17 years away. Now, I don't know if it ever gets cut to zero, but we're going to have huge cuts in the next 17 years. Have you noticed the EVs with the tax break are the same price now as a gasoline car? Think that through. The gap in the prices is completely covered by the tax credit for buying an EV now. So why the heck would anybody not buy an EV? Especially in about 2 years when all the batteries go 500 or 600 miles. You don't have to buy extra. That's how good the technology is getting. So by 2026, the year that we've been talking about since 2020 when I was at CES, you're going to have cars that are all about the same price. Gasoline, EV. The EVs will get around 500 or 600 miles to the charge that you can do overnight in your garage. And now that we've standardized the charging networks and everybody's going to be able to use everybody's, why on earth would you not buy an EV if you're going to buy a new car? Well, here's another reason. There are not going to be many to buy. Ford has already said they'll stop making non-EVs in Europe by 2027 and 2030 in the United States, with the exception of some specialty cars, right? They might do a hot rod still. But unless it's a work vehicle of some sort, it's going to be EV. Even some of those will be EV. World's changing fast. The clean energy transition, biggest transition ever, equivalent of going from the horse and buggy to the car. Healthcare select sector, you're going to see margins start to go up because of AI, and it's coming off of an oversold period. So I'm starting to get into healthcare. It's going to be a long road there, but at some point there'll be a heck of a rally. Hard to predict exactly when those come. I will trust Shooter to tell me, hey, time to back up the truck. We also want to start thinking about the Wisdom Tree Indian Earnings ETF and the Freedom 100 Emerging Markets. Why? Because if the dollar drifts down for the next few years before its next big bull rally, which is what I'm projecting and seems to be most likely, and because these are the places where the most growth will occur, they're pretty much buy the dips source of investments. The Freedom 100 Emerging Markets ETF, I picked out because there's no China, Russia, or other dictatorship countries in it. Countries where it's very hard for them to manipulate things. So I have other funds available, which I can show you either on the VSL or in this 401k model portfolio to give us different access, different exposures. So some of these funds have China, some of them don't. Emerging markets, small cap dividend has had some monster years to the upside. we'll keep an eye on that. So I picked these pieces not only because they're good funds, because I can use 2 or 3 of them at a time, depending on what I want the asset allocation to look like. Same thing up here with the sector funds. Then these are the large, medium, and small cap funds. So I never use SPY because why would I? There's better funds out there. I can use QQQ, or if I want broader exposure, this Invesco S&P 500 GARP ETF, growth at a reasonable price, beats the whole index all the time. Or I can use the Russell 1000 dynamic multi-factor, which incorporates some quantitative analysis. These two do about the same over a long period of time, but there's shorter time periods where one will be a little bit better than the other based on economic data that we can track. So I added to both of those while I reduced QQQ. You always want to have a core position in some large caps so that you get access to the market, right? The mid cap and the small cap, I'm looking for quality. At some point when we get a roaring bull market, we'll switch to momentum. Different circumstances, different pie chart. So I talked about the 4 large cap funds. I encourage you to read this. It'll explain to you why each of these are in the plan and whether you're in this 401k plan or not. I mean, why you would use them on your own. So if you just want large cap exposure, never use the Spider S&P 500. Use one of these. So go ahead and read this. I'll just show you the comparison here. The S&P 500 is this bottom line going back to 2018. QQQ has done the best, mainly because it just broke out. But you can see for periods of time, they're pretty close to each other. GARP has done pretty well. That's probably the one that most people should use. If you go all the way back to 2012, because the multi-factor ETF is newer, only goes back to 2018. If you go all the way back to 2012, you can see the pronounced difference. QQQ, much wider range, right? Bigger ups and bigger downs, which is why you can trim it here with the hope of buying it back down here. GARP just keeps opening up room on the S&P 500. So why would you ever invest in this, which is what most people do, when you can invest in one of these? Show me the money. All right. Anybody who's in the 401k plans that are opening up this week would like to get a hold of me. Your employers have my email address. You can go to bluemoundam.com and find me. Just contact Kirk Spano, and the 401k article will actually be posted here. So have a good rest of the week, and get in touch if you need to. If you're in an investment letter, find me in chat and talk to other investors in chat. Now that we have the groups available and fundamental trends, there's all kinds of stuff in here for you. All right, take care. Thank you, Shooter.